Sure. So I would say the truce is nice, but what we'd like to see is an actual resolution. So at one point in time, resolution looked like China agreeing to buy billions of dollars of agricultural products from the U.S. So again, the truce is nice, but we'd like to see an actual outcome. It's something we're monitoring closely because we would argue it had the biggest impact on tech stocks in the first half of this year.
Brent, what it means for Alphabet as well. I mean, I know they had put a hold earlier when Huawei got added to the entities list here in the U.S. Is there upside for that company, even though we don't have the details around what this truce could look like?
I think for the internet names, it's a modest tailwind. It's probably more impactful for the travel-related names like Expedia and Booking. They saw some slowdown due to some reluctance of travelers in Asia, so this will potentially help the travel names. For Google, I don't really think there's a huge impact. The stock has been under a lot of duress from the first quarter miss as well as the lack of disclosures from Google. So I think there's a bigger cloud over the stock as it relates to the way that they're running the company and the way that they're overhanging the operations rather than anything in China at this point.
Tom, as you said, a truce is nice, but do you really see a way forward? How do you actually get a deal from here? We're talking about Alphabet, yes, some reprieve in terms of being able to supply their operating system to Huawei, but in the long term, what does this mean if Huawei's particularly turning away from U.S. suppliers?
Sure. So if you look at Apple, for example, China's been the biggest risk for the stock with 20% of their sales to Chinese consumers, and last week's news that they're moving their production for the MacBook to China from Texas. So I think that what you're seeing is a lot of companies still want to make their products in China because in many instances, China is still the lowest cost producer for that sort of thing. But again, I think the ideal, which won't happen, is that they'll protect our property rights to a greater degree. But I think that, again, if you look at what the almost deal was, it was for China agreeing to buy billions of dollars of agricultural products. It'd be interesting to see if that is the quote-unquote outcome we're looking for.
Brent, when you look at how the FANG names overall have done so far year to date, Facebook up, 47%, Amazon up more than 25%, Apple 25%, Netflix up 37%. Yes, Google is the laggard, or Alphabet, I should say, is the laggard here. But is there still room to run in some of these names that have performed so strongly in the first half?
Yeah, as you mentioned, FANG's up 27% year to date. So with that kind of gain, you tap the air brakes a little bit and do a check. We do think the fundamentals are still very good. If you look at the rally we've seen, it's largely been in growth. We're starting to see on our trading desk a shift back to value. So we're seeing clients move back to value-oriented names. That would benefit someone like a Google going forward, given the run we've had. But we continue to be really bullish on Facebook. It's the strongest ROI we see in advertising right now. And we think they're capable of $10 of earnings power 2 years out. You need to put a low to mid 20 multiple on that, and you have a $230 to $250 stock. So you still have a lot of room in Facebook from our perspective. And again, some of the value names like Expedia, Google, even in mid-cap, GoDaddy, we like offer, I think, a really interesting entry point at the current levels.
Brent, does those numbers you just rattled off for Facebook, does that handicap the possibility of regulatory risk?
You know, it's all these stocks. It's the number one asked question from our client base globally. I think investors have put a much lower multiple on internet than they have on semis and software. You look at semis and software and the run that they've had. So we think that a lot of that concern's baked into the stocks. You never know exactly what's going to happen, but we don't believe that there's a big breakup coming for tech. We think there's going to be increased attention from regulators as that's their job to do, but we don't think that there's a dramatic impact to their core business at this point. So it doesn't reflect a huge regulatory overhang. It does reflect already the concern from investors in the multiple today. And again, I think a low 20 multiple for Facebook growing EBITDA. At a mid 20% clip is not an unreasonable number to pay for a great growth story.